Good evening, everyone. Welcome to first half performance of HNB National Bank. First, I will take you all through the presentation and then I'll open up for questions and answers. Interest income for the first going through the bank's performance. Interest income for the first half grew by 9.6%, interest expenses by 5.6%, and as a result, NII grew by 15%. Fee income grew by 8.8%, slightly lower than what we have seen in the past. Main reason has been fee income coming from granting of TODs have come down as a result of credit has been more conservative in terms of providing credit and being cautious and reducing our TOD exposures, as well as fee income growth in terms of guarantee income has also not grown as much as what we have seen in the past, as well as fees coming from other loan products. Net trading losses have increased from 2017 first half to 2018 as a result of the depreciation of the rupee, but at the same time we have seen that getting compensated through other operating income. Impairment has increased as a result of NPAs going up. Net operating income as a result has grown by 16.3%. Expenses growth has been well managed at just 6.7%. Overall, PBT grew by 35% and PAT by 20%. At a group level, more or less the numbers tend to reflect the same as that for the bank. Apart from maybe the profit growth numbers have been much higher at PAT growing by 26.9% and profit attributable to shareholders growing by 25.8% as a result of fairly good performance shown by HNB Assurance. That also includes a one-off transfer of profits which was there for insurance companies, and even without that HNB Assurance has done fairly. So this graph shows you how PAT has grown for the bank by 20.6%, and as I mentioned earlier, contributions from NII, fee income and other income, while cost, impairment and taxes have increased. Same for the group as well. Overall, the balance sheet year on year, assets have grown by 8.6%. For the bank, grew by 9%. It's been lower than what we have seen for over the last 5 years, where a CAGR of 18.6% and at a group at 19.1%. But in terms of the year-on-year growth has been much less than what we have seen, again because we have been cautious in terms of growth, especially towards the latter half of last year. We actually slowed down our growth, but if you compare the 6 months, I think the growth has picked up compared to what we saw in the 6 months of last year. The HNB group surpassed 1 trillion rupees in terms of asset base last year, and this year we have seen the bank also crossing the 1 trillion mark. And at a group level, loans have exceeded 700 billion. In terms of NIMs, despite us expecting that NIMs to come down during this year, it has been the opposite. We have seen NIMs improving at a bank level as well as at a group level. The bank NIM stands over 5%, while the group NIM stands over 5.5%. which is fairly healthy. In terms of asset or the loan mix, we still have a fairly high amount in wholesale lending, which is around 48%, which we probably would expect to come down over a period of time, and retail and SME at 52%. Deposits, still the CASA mix is fairly robust at 36%, while the LKR CASA remains at 37%, and FDs remain at 64%. So this is a breakup of fee income. As I mentioned, fee income growth was a bit subdued during this year compared to the previous years due to the reasons that I mentioned. But it's encouraging that fees from credit cards have grown have seen fairly healthy growth during this year. In terms of cost to income ratio, we have seen operational efficiencies continuing. Cost to income ratio came down by 450 basis points during 2018 at a group level to 44%, and it reduced by 373 basis points at a bank level to 37.7%. So NPAs, which started moving up in 2016, has continued in the first quarter, where we saw NPAs going up to 2.72%, and in the second quarter the increase has more or less reduced, but still we have seen NPAs moving up to 2.91%, and we expect that we will be able to bring the ratio down closer to the 2% levels that we aspire towards the latter part of the year. So we are fairly healthy in terms of our capital adequacy ratios after we did a rights issue last year, and we are fairly comfortable that we can continue our growth trajectory without needing any tier 1 capital for the foreseeable future. So at a ROA level, we have seen ROAs improving. ROA at a bank level increased to 1.76%, up by 16 bips, while at a group level it went up to 1.85 by 24 bips. But at an ROE level, I think ROE levels have come down mainly as a result of higher lower gearing due to the rights issue that we did last year. So the DuPont analysis shows how the ROAs have moved and how the ROE has come down despite ROA, and we believe that with more leverage happening in the balance sheet, that the ROE levels will keep rising towards the 20% levels that we aspire. So this is on shareholder returns. Overall price to book value of the share remains at 0.87, PE at 6 times, give a dividend yield of 4% for the voting share and 5% for the non-voting share. Unfortunately, the share price has not performed as we would have liked it to, due to market conditions not being too favorable. So these are all the awards that we have won, and we have continuously winning awards over the last several years, and these are some of the awards that we have won during this year. So with that, I would conclude my short presentation and open it up for any questions and answers. For any questions. What are these construction NPAs linked to GOS? There is a question asking, what are these construction NPAs linked to GOSL? Please can you elaborate, because there aren't any construction related in there has been delays that have been happening in terms of payments from the government to subcontractors who are doing maybe road construction and so on and so forth. So that has affected some of the payments of these small time subcontractors, and that we have seen even in the past. In 2015-16 also there were cash flow difficulties, and you saw certain NPAs coming up as a result of that, but those then get settled as the cash flows come through. So there's been few like that, but nothing in terms of GOSL not paying and going into it. What kind of loan book growth expected in future? As we see, loan book growth is slow compared to the industry. I don't think it's necessarily slow compared to the industry, because if you look at the 6 months growth, we have done about 8.7% growth. So we are looking at around a 15, maybe around 16-17% growth, which I believe will be more or less in line with the industry. Year-on-year growth is low. That's because last quarter, growth was low. So that is the reason why year-on-year growth be lower than the industry. What is the reason behind the corporate tax to PBT increasing? So that's as a result of various things, because SLDBs are not earlier SLDB investment interest from SLDB investments were exempted from tax. These all been taken out now. So as a result, the effective tax rate has gone up overall. So from which sectors the asset quality pressure is coming from? I believe it's mainly from agriculture, but it's also from trade. You have seen an increase in NPAs, seen mainly on the SME sector. NPAs have gone up substantially. So I wouldn't pinpoint it to one particular sector, except probably a disproportionate increase in NPAs in the agriculture sector. So there is a question on benefit claims on underwriting expenses have grown up. This coming mainly from the insurance subsidiary. So in the second quarter, I think there were a few claims that came through as a result of weather patterns and the floods that happened in certain areas compared to the first quarter, though it was not significant. Compared to the first quarter, the claims have been higher. So that's why the second quarter claims probably is higher than compared to what we saw in the first quarter. But overall, it's lower than what we saw in the first half of 2018. So there is a question on the one-off profits of HNB Assurance. This is because of the basis in which capital adequacy for the insurance sector was calculated. That change happened in 2016, and the resultant one-off profit that came from this change in the basis was not allowed to take to the P&L until last year. So you would have seen, if you looked at the P&Ls of most of the insurance companies, there was a large one-off gain that got transferred. Most of the companies took it for 2017, but HNB Assurance actually took it in 2018. So I think that's been classified separately also in the P&L of HNB Assurance as 381 million. So the construction sector NPAs have not been alarming as such, especially on the condominium sector. If at all, it comes from delayed cash flow payments that are happening because the what I mentioned earlier, the delays in government paying some of the subcontractors contributing towards the increase in NPA. But other than that, we have not seen any stress coming from the condominium sector. Like, it's not been a systemic issue of any in the construction sector that has caused any alarming impact on NPA sizing, but a cash flow. So again, I think the question on loan book growth is there. We expect the year to end at around 16 to 17%, and I wouldn't expect it to be much more than that, and it probably be somewhere there. So there is a question as to why you expect the NPA ratio to come down. That's because we're working hard on recoveries of some of the larger NPAs that we have, as well as the new NPAs going in has kind of reduced over the last few months. So with that, we expect the NPL ratio to come down over the next 6 months. So there's a question on cost of risk. I believe this year cost of risk would probably be between maybe 30 to 40 bips. But overall, I would expect cost of risk to hover around 30 bips. So there's a question on interest rate risk. We actually expected interest rates to move down, and that's the reason why I said we were expecting margins to also probably come off slightly. But what we have seen is that interest rates have been holding on to its current levels, and with US dollar rates moving up, it seems a bit difficult to expect rates to significantly come down in the near future. So and it's unlikely that the rates would go up either. So my expectation that these rates probably will see over the next 6 months. So there's a question on whether there are any specific sectors we focus on loan growth. Not really. I wouldn't say that we are very sector specific, but we will want to push loan growth in retail as well as in SME segments. So that's something we'll continue to do, and corporate lending would be more short term and will be more filler rather than an aggressive strategy on growing the corporate loan. So operating income increase is as a result of the depreciation of the exchange rate, where the swaps get repriced, and the loss of the swaps getting repriced comes as a net trading loss, and the on-balance sheet revaluation will come as part of other operating income. In addition to that, the regular customer the exchange gains you get from the customer transactions will also get parked under other operating income. So altogether, we have seen a fairly healthy increase in other operating income. So there's a question on what happens if a 7% VAT is levied. So I guess you can easily calculate it if you divide the VAT by 15 and multiply it by 7%. So it will be basically 50%. The current VAT that we pay will increase by 50% if it gets implemented, but still there is no clear circular or clear information as to when it would or whether it would get implemented as such. So there's a question on HNB Grameen. Grameen is doing okay, but yeah, the asset quality has deteriorated compared to what it was in line with the finance and the banking industry. I guess sometime back the NPA was just around 1% or less than 1%. Now we see an NPA closer to around 4%. But it's nothing alarming, but has deteriorated compared to where it was. So there's a question as to why NIMs have increased, because the interest rates have continued to stay high, and with that I believe deposit rates compared to last year has come down slightly. If you look at last year, I think 1 year FD went at around 11.5%, 12%. Now it has come down to around 10.5% to 11%. But the AWPLR still remains fairly high, over 11%. So that's the reason as to why the NIMs have improved, and also the CASA ratios have maintained healthy around 37, 38%. So IFRS 9 one-off impact through the reserves would be around 4 to 5 billion rupees. Other than that, the impact on the PNL would not. It's difficult to estimate at this point in time, because it will depend on how the NPAs would move towards the latter part of the year. But I wouldn't expect that to have a significant impact on the PNL. I would say it will be more or less in line with the impairments that we have already made. So there is a question on whether increased yield means higher risk lending. No, it is not higher risk lending. I think it's more than yields increasing. I think it's the cost of funds coming down that has improved the margins rather than yields. Will you write off the IFRS 9 impact on one go? I think it will come to the reserves on one go, but how you would take it for calculating capital adequacy ratio, I think the central bank has allowed the 3-year window, if I'm not mistaken. So we'll probably use that window, though we probably will not need it, but we might use it. So there's a question on Magampura loan that was given to Magampura, which went bad last year. What is the status? I think we are working with the government to recover it, and very positive that we will be able to recover it. So that's all what I can say at this point in time, that we are hopeful that the recovery will come. So there's a question on what is the expected effective tax rate. I believe with the current taxation, the effective tax rate would be somewhere around 46, 47%. But of course, if another additional 7% comes in, so that will increase to over 50%. So there's a question on CASA dropping in the quarter. I think, there's a fair amount of corporate CASA that we are getting through our cash management system that we have introduced latter part of last year. So there's a lot of corporate CASA coming in. So the corporate CASA tends to come in and go out, and you actually see the CASA as per one date. So it's on the 31st of March and 30th of June. So on average, it's been improving, but on a single date, it can actually come in and go out. But on average, we've been happy in terms of the CASA performance. So there's a question on what do you expect provisions as a percentage of gross loans for the full year. So I guess you're asking about the credit cost. So credit cost, as I mentioned earlier, we would expect something in the range of 30 to 40 pips for the year. This is with the expectation that we probably would, the increase in provisions will not go in the same line that we, and of course we have seen that the NPAs have been, new loans going into NPA has reduced, and we are also hopeful in recovering some of the large NPAs that are there, and with that we do not expect the provisions to increase significantly during the latter part of the year. So there's a question on insurance business, whether there will be a slowdown. We don't expect there to be a slowdown, and both the general and the life insurance has been doing fairly well during this year as well. There's a question, what caused the increase in personal expenses? I think personal expenses has been well managed at just 1% for the half. If you take the bank, and at a group level it's 6%. So I don't think there's a significant hike as such. It's a question on what is the ROE level that can be achieved this year. We would want to at least target the ROE going up to 16%. So that's probably what we would want to target for this year, and then slowly take it up to the 20% levels as the balance sheet leverage improves. So there's a question on banks asking write-off of micro debt less than 100,000. This won't affect the bank. Of course, it will have an impact on Grameen, but still they have said that any write-offs will be compensated through the central bank. So in which case there wouldn't be an impact on the P&L. And so we are working with the central bank in terms of seeing how this scheme works. So there's a question on how much of the 48% wholesale lending is government public sector related projects. I would think it would be around 5 to 6% of the overall book. So there's a question on whether the collective agreement has taken place. Not yet. So it will come in the second half. So there will be a higher increase in personnel cost likely in the second half than what we have seen. So those are the questions that I have got here at the moment. I believe I have kind of addressed most of it. Any other questions? There's a question on why has the other expenses gone up by 17%. 17% increase has mainly been in the group, and at a bank level it's been 11%. So I believe it probably is coming either through Grameen or assurance, which I need to check from exactly where that is coming. At a bank level it's at 11%. There's a question on what resulted in a 6% Q-on-Q hike on personal expenses. So you're looking at 2017 second quarter against 2018 second quarter. There could have been because the provisions that were made in terms of salaries, or maybe some of the expenses might not be like some of the allowances claims that are made probably differ, so that could be the reason for a Q-on-Q check. So, but it's more appropriate probably to look at the half, how it has moved, rather than just looking at the quarter itself. So any update on debt repayment levy? I think that's what they have now trying to bring it by way of a higher VAT, which I discussed earlier. So even that, when it will be implemented, how it will be implemented, it's not been very clear. So there's a question, can the debt repayment levy be passed to the customer? Well, if it comes as a VAT, then it's unlikely that it can be passed on to the customer. So again, there's a question on whether the debt repayment levy will be there only for 3 years. So if it is now been brought in by way of an additional VAT, then it probably may not be just limited to the 3 years, but still I think a lot of us are in the dark in terms of the overall mechanism as to how it will get affected. So probably we'll have to wait and see how things unfold. Is this levy more cost effective than the proposed one earlier? Yeah. Calculating the debt repayment levy the way it had been proposed earlier would have been a nightmare, and I don't think we probably would have had to do so much of system developments to calculate it, and probably bringing it as a straightforward VAT probably is much more administratively easier and cost effective than bringing it as a debt repayment levy. What is my thoughts on the next year with presidential elections coming 2020? Well, I think the loan growth will remain slow because I don't think there will be too much of large-scale investments that will happen in 2019, with 2020 outcome of a presidential election being uncertain. So we'll expect loan growth to remain low around 15% or so on, rather than seeing a significant growth like what we have seen in 2015-16. IFRS 9, 4 billion, 4 to 5 billion, is it net of tax? So it doesn't come to the P&L, it goes through reserves. So there will be a 4 to 5 billion impact on reserves net. So there's a question as to when the one-off gain reported by the insurance company get distributed as dividends. Well, I think the dividend already, the insurance company paid a fairly good dividend. I think we will probably not be distributing the full amount as dividend like some of the multinational insurance companies have done. We'll probably use that money for the growth in the insurance business. And we have seen the insurance business growing, and last year they did a ROE of around 28%. So we would want the business to grow. So if there aren't any more questions, thank you very much for joining this WebEx call, and hope to see you all at the third quarter results update. Thank you very much.